Hello, good day. I hope you are fine. I hope you have a great time learning at home. I understand we all have to stay at home during this movement control period to combat the COVID pandemic. However, staying still could be a good opportunity to explore and learn if you plan your time and find joy in what you choose to do. The objective of this video is to help students to understand the foundation of portfolio theory. You will learn some basic concepts such as systematic risk, unsystematic risk, correlation, diversification, efficient frontier, capital allocation line, capital market line, and market portfolio. I hope these concepts do not sound too abstract for you. No worry, it won't be difficult. At the end of the session, it is hoped that students will understand how diversification can reduce risk and how investors should maximize return and minimize risk. Stay tuned and happy learning! What is a portfolio? Let's define portfolio. Portfolio is a combination of two or more securities or assets. Investors rarely place their entire wealth into a single asset or investment. Rather, they construct a portfolio or group of investments. Therefore, let's extend our analysis of risk and return to include portfolios. What happens when we combine a number of risky assets into a portfolio? We are going to learn some of the important concepts in portfolio theory, such as diversification, correlation, and risk reduction. Then you will know the answer why we combine a number of risky assets into a portfolio. Ultimately, it is important to note that the purpose of portfolio theory is to choose an optimal combination of assets, one of minimum risk for given return or maximum return for given risk. Let me ask you a question. Consider the following two assets plotted in risk-return space. The x-axis represents risk or standard deviation. The y-axis stands for return. Which asset would you choose? Asset X or asset Y? Would any investor want to invest in both assets? Why? Let's think about it. Clearly, asset X dominates Y for any rational investor who is risk averse, since asset X has higher return and lower risk. An investor may invest in both X and Y, depends on the covariance or correlation between X and Y. How and why? We are going to learn further in the next few slides. Stay tuned. Have you heard about the idiom, "Don't put all your eggs in one basket"? This is a piece of advice that one should not concentrate all efforts and resources in one area, as one could lose everything. The idea is to spread your risk across a number of assets or investments. Diversification involves the inclusion of a number of different investment vehicles in a portfolio. It is an important aspect of creating an efficient portfolio. A numerical example from Kane 1995 shows that the standard deviation of a market portfolio as represented by S&P 500 has lower risk than individual stocks such as Delta Airlines, Dow Chemical, or PepsiCo. The standard deviation of S&P 500 of 17% is lower than any of the three stocks. In the table below, when the number of stocks in a portfolio increases, the average standard deviation of portfolio return reduces from 49%. When there are 8 stocks in the portfolio, the standard deviation almost reduced by half. From 50, 100 to 1000 stocks, there is not much difference between the standard deviations. The risk represents the market risk that cannot be eliminated. Total risk consists of two types of risk: unsystematic risk and systematic risk. Unsystematic risk is also known as diversifiable risk, unique risk, idiosyncratic risk, or firm-specific risk. Unsystematic risk is caused by firm-specific or random causes. These events are unique to a particular firm. For example, strikes, lawsuits, loss of key account. Unsystematic risk can be eliminated through diversification because these events are random. On the other hand, systematic risk is also known as non-diversifiable risk or market risk. Systematic risk stems from factors that systematically affect most firms. For example, war, inflation, political event, recession, high interest rate, earthquake, or international incidents. Systematic risk cannot be eliminated through diversification. In the figure, the blue line represents unsystematic risk and the red horizontal line represents systematic risk. The figure shows that unsystematic risk gradually disappears as the number of assets in the portfolio increases. No matter how diversified the portfolio is, the systematic risk cannot be eliminated. Systematic risk is attributable to market factors that affect all firms, as any investor can create a portfolio of assets that will eliminate diversifiable risk. The only relevant risk is non-diversifiable risk. Any investor, therefore, must be concerned solely with non-diversifiable risk. In this slide, we consider a portfolio with two assets, asset X and asset Y. This slide shows the list of formulas to calculate portfolio return, expected return, variance, and covariance. The portfolio return is simply a weighted average of the individual asset returns. The weights are equal to the proportion of total funds invested in each security. The weights must sum to 1 or 100%. The portfolio variance equation considers the covariance between two assets. Covariance is a measure of the degree to which two variables move together relative to their individual mean values over time. Correlation coefficient is a statistical measure of relationship between any two series of numbers. From the formula, you can see that the correlation coefficient is calculated by standardizing the covariance by the product of the individual standard deviation. Correlation coefficient can vary only in the range of -1 to +1. If two series tend to vary in the same direction, they are positively correlated. If the series vary in opposite directions, they are negatively correlated. A value of +1 indicates a perfect positive linear relationship between two variables. A value of -1 indicates a perfect negative relationship between the two returns. When the correlation equals 0, the returns are uncorrelated. That is, they have no tendency to move either together or in opposite to one another. Independent risks are uncorrelated. Let me ask you a question. How is correlation between assets related to diversification? For effective portfolio planning, you need to understand the concepts of correlation and diversification and their relationship to a portfolio's total risk and return. From the figure, we can see that both asset F and G earn the same average or expected return over time. The return of asset F and asset G move in opposite direction. They are negatively correlated. When the return of asset F is above average, the return of asset G is below average, and vice versa. When these two assets are combined in a portfolio, the risk of the portfolio falls without reducing the average return. In the third diagram, we can see that the variability of return is lower. The standard deviation of the portfolio has been reduced, and the portfolio return has less volatility. As conclusion, to reduce overall risk, it is best to diversify by combining or adding to the portfolio assets that have the lowest possible correlation. Combining assets that have a low correlation with each other can reduce the overall variability of a portfolio's return. It is important to distinguish between naive diversification and optimal diversification. In naive diversification, weights are equally allocated among assets. For example, a portfolio of 5 assets will have a weight of 1 per 5 for each asset. In optimal diversification, weights are calculated so as to minimize risk and maximize return. We can use mathematics model or Excel software to calculate the optimal weights. You will learn optimization in portfolio management during your second year of undergraduate study. In some cases, you can even have a negative weight if short selling is allowed. Note that all weights should add up to 1, irregardless of with or without short selling. This figure shows the investment opportunity sets for asset A and asset B. The investment opportunity set is also known as the mean variance frontier. If we invest 100% of the fund in asset A, we are at point A. If we invest 100% of the fund in asset B, we are at point B. The weights vary along the line. The shape of the investment opportunity set depends on the correlation between asset A and asset B. For portfolio P1, the correlation of asset A and asset B is positive 1. The lower the correlation, the more the investment opportunity set will shift to the left. For example, portfolio P2 has a positive correlation that is less than 1. Portfolio P3 could have 0 correlation. Portfolio P5 has the lowest correlation as compared to the rest of the portfolios. When the investment opportunity set is curved to the left, the risk or standard deviation is lower for the same level of return. We shall learn more about the mean variance frontier in Year 2 portfolio management. I hope this slide will serve as an introductory to you. We can combine assets in various ways. The shaded area in the figure shows the various possible combination of assets to achieve different level of risk and return. Although all the points on the shaded area is possible and achievable, a risk-averse investor will try to minimize risk and maximize return. This means an investor will try to select the portfolios on the curve AB, which dominate all other portfolios below the curve AB. For example, portfolio B offers a higher expected return as compared to portfolio C, despite the two portfolios have the same standard deviation. Portfolio B dominates portfolio C. Investor will choose portfolio B over portfolio C. AB is known as efficient frontier. An efficient portfolio is one that provides maximum expected return for a given level of risk or minimum risk for a given expected return. Point A is known as minimum variance portfolio as it offers the lowest standard deviation. What will happen if we combine a risky asset and a risk-free asset in our portfolio? What is the impact on the return and risk of the portfolio? This slide shows the formula to calculate the return and standard deviation of a portfolio that combines a risky asset and a risk-free asset. A good example of risk-free asset is the treasury bill issued by government. X represents risky asset and F represents risk-free asset. W represents the weight or proportion of investment in risky asset. 1 minus W represents the weight of investment in risk-free assets. The return of the portfolio is the weighted average of the rate of return of risky asset and risk-free assets. We can use the formula for standard deviation of a two-asset portfolio to calculate risk. As risk-free asset has no risk, its standard deviation is zero. Its covariance with risky asset is also zero. Therefore, the formula can be simplified as weights of risky asset multiplied by the standard deviation of the risky assets. When we combine risky asset and risk-free asset, our possible risk-return profile is a straight line, RFXY, as shown in the figure. We can vary the weight of investment and achieve the different points on the line RFXY. At point RF, 100% of wealth is invested in risk-free asset. At point X, 100% of wealth is invested in risky asset. Along the line RFX, less than 100% of wealth is invested in risky asset. For example, we can have 50% weight in risky asset and 50% weight in risk-free asset. This position is known as landing. Along the line XY, more than 100% of wealth is invested in risky asset. For example, we can borrow at risk-free rate and double our investment in risky asset. This position is known as borrowing. Capital allocation line is a graph showing all feasible risk-return combination of a risky asset and a risk-free asset. RFXY is known as the capital allocation line. Take note of the line with a negative slope RFZ. What does the line RFZ represent? Here, investors are short-selling risky asset and investing in risk-free asset. We can see that the line RFZ is dominated by RFY, as the upper line offers higher expected return for the same level of risk. Let's define market portfolio. A market portfolio is a theoretical investment portfolio that includes every type of asset available in the investment universe. The proportion invested in each asset corresponds to its relative market value. The expected return of a market portfolio is identical to the expected return of the market as a whole. A market portfolio, by nature, is completely diversified and is subject only to systematic risk, the risk that cannot be diversified away further. The capital market line is a special case of the capital allocation line, where the risky portfolio is the market portfolio. Portfolios that lie on the capital market line, in theory, optimize the risk-return relationship, that is, maximize return and minimize risk. The intercept point of capital market line and efficient frontier will result in the most efficient portfolio, called the tangency portfolio or market portfolio. When we invest 100% fully in market portfolio, we are at point M. To the left of capital market line, lending is involved. To the right of capital market line, borrowing is incurred. There are two reasons given here about why M is the market portfolio. Basically, rational investors will try to maximize return and minimize risk. Investors will try to maximize their utility. Tobin's separation theorem is about combining risky asset and risk-free asset by using lending and borrowing. We will learn more about Tobin's separation theorem in second year in the portfolio management module. So, not to worry, we will learn more in detail. Understand the basics is sufficient for the time being. If you can explore further on your own, that will even be better. Happy learning! Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.